Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Vasileios. It's fantastic to have you on the podcast show.
Hello, Bilal. Very glad to be here talking to you.
Great. Now, before we go into the heart of our conversation, I do like to ask all of my guests something about their origin story. So in your own words, what did you study at university? Was it inevitable you'd end up in finance? And what are some of your key career milestones along the way?
So I'm an economist by training. So I did my master's and then my PhD at the LSE. LSE is heavily geared towards academic careers. But at some point, I decided I wanted something a bit faster moving. So I decided that I'd really like to start migrating towards the private sector. My initial experience was a fantastic experience. It was with a prior guest of yours at some point with Gavin Davis at Fulcrum Asset Management. A great bunch of people, extremely high intellectual environment, really fun to work with these people. It was definitely one of my milestones because I've learned quite a lot. I've evolved from someone who was with econometric models into actually applying them in the real world and getting the first slaps on the face when this forecast were going terribly wrong.
We've all been there. We've all got the scars.
Oh yeah, absolutely. But it was a great experience. It was a great school. I'm still in contact with them, though not as much as I would like to. Obviously, all of us are pretty busy, but we'll try. Hopefully, we'll try to catch up fairly soon. So after that, I worked with a prior colleague of Gavin from Goldman, Lombard Odier at Bank of America Merrill Lynch. There I was doing emerging markets economics and strategy, basically. So I was covering global emerging market economics and strategy. From then on, it was a great experience at Bank of America Merrill Lynch. It was a big organization. I wanted just a tad bit more responsibility. UniCredit approached me and they said, would you like to take ownership of the FX space? So I've agreed to that. It was really also a great experience. Traveling very much into Europe is my thing. I love European people. I love interacting with European people. So I stayed there for about 5 years. Then I made quite a big change.
And what years were you there at UniCredit? Was that during the sovereign crisis or?
Yes, I was 2012 to 2018.
Okay.
So it was during the
powerful period
sovereign debt crisis. Yeah. And as a matter of fact, because of me being Greek, I was pretty much covering Greece and all the developments back then and in relation to the euro. Then between 2018 and November 2021, I went to Lombard Odier, the wealth management, in Geneva. So although my home was in the UK, my workplace was in Geneva. So I was pretty much commuting every week during the COVID years. So it was quite, interesting. The stories I can tell you about this experience in the airports, in the border control, it's just very funny. Well, it wasn't funny at the time, but
funny now, but not then, I can imagine. Yeah.
Then went back to the sell side at Citi to run the European FX strategy research. And now, since the beginning of this year, I'm responsible for European economics and strategy at Aviva Investors. Very much enjoying it. Great bunch of people, great brainstorming, very intellectual environment. It's a great place to be.
And I guess this is a return to the buy side, because if you worked with
it is a return.
Fulcrum was the buy side, and then you went sell side, now back.
Yeah, it is a return to the buy side. Yeah, exactly.
That's really good. Well, we have a lot to talk about. There seems to be elections popping up all over the place. But let's start maybe with the UK, which seems to be the simpler election to discuss, at least in the context of markets. Well, I think it is. Correct me if I'm wrong. But what do you think about UK elections? Obviously, we had the Bank of England as well. There's been a big focus on the Bank of England to cut rates over the last year. They haven't so far, and now they're kind of moving closer to that. I mean, what's how you're looking at the UK in terms of these two factors.
So, first of all, let me start with my main concern about the UK. And my main concern in the UK, and when I cross-check it with the other developed markets, is basically a nearly complete absence of consumption growth. Household consumption growth has been flatlined pretty much since the pandemic, and that's one of the things that has been worrying me, both in terms of the challenges that the Bank of England is facing, as well as in terms of the growth profile. To be honest, I fully agree with you. The elections are probably the simpler ones that are ahead of us. I think, the possibility of a strong government could provide some sort of sense of less uncertainty and some more stability. So that could be good news. I don't think a lot is going to change on the fiscal front, at least for the next year or so. So I don't really think it's going to be that market relevant. Of course, there are always risks. In terms of the Bank of England, look, personally, as well as from our institutional perspective, we've been, I would say, on the dovish side of expectations, the main pillar of that has been, for me, that it is very difficult to sustain high inflation in the absence of aggregate demand. And more specifically, I'm referring to household consumption, the absence of household consumption growth. I think for this meeting, the BofA is going to stay packed, largely because the April upside surprise was a setback. The interesting thing about that report was the upside surprise in services inflation, which was quite widespread, actually. I suspect a lot of that is going to revert in tomorrow's reading for the May CPI report. But I think
I should just give a timestamp to our listeners that we're recording this on Tuesday, the 18th of June. So
that's right. That's right.
Come after some of those events. I just have a question. On that, you mentioned quite convincingly the lack of consumption growth. Then where is this inflation coming from in the first place in the UK?
One of the things that we have to remember is that the UK actually started experiencing inflation a bit earlier than the other developed countries. And as a matter of fact, the overshoot of inflation was actually a bit higher. And I think that a large part of it is coming from the fact that on one hand, we have an extremely tight labor market. And on the other hand, there have been some changes in the UK economy over the past 4 or 5 years that allow some pass-through from imported inflation into the UK. But I don't really expect that this situation is going to sustain for too long. And that's why, although I expect that the BofA is not going to come out and say we have the confidence to cut rate in June, because of the setback in the April reading, even if that reverses fully in the May reading, I'm pretty sure the hawks are going to say, well, yeah, but there is a lot of volatility. So that does not really increase our confidence. The other thing, which I think going forward, August for me is the most likely time for them to start cutting rates, of course, assuming that inflation cooperates along the lines of what I have in mind. It will be a good time for them because they will update their projections in the August meeting in the inflation report. I think we are likely to see some further deterioration in the growth profile, which will allow the bank to cut 2 times this year. This is my base case. This is my central scenario. Another thing that I'd like to highlight. Oh, by the way, you asked me about why inflation. The other thing we have to bear in mind is that productivity is exceptionally low. Productivity growth is very, very low in the UK. So that's definitely something to bear in mind in terms of contributing some sustainability in inflation. I think another thing that's worth highlighting is the fact that if you look at the effective mortgage rates, which is basically the composite cost of mortgage rates out there, they're still rising. And I'm talking about the outstanding stock of mortgages, which is it's the vast majority of the mortgage market out there. So for me, of particular interest is not what's happening in the 2-year, 3-year, 5-year mortgage rates, but what's happening on the weighted average of mortgage rates on the outstanding stock of mortgages. And this is still rising. And if you contrast that with the Eurozone, where it actually peaked in November of last year, this is, quite a significant discrepancy, meaning that there is pain still in the pipeline, whereas in the case of the Eurozone, we are really past that peak in monetary policy impact.
Okay, that's a fair point. Yeah, because a lot of people, when they looked at the UK, they were looking at these 2-year mortgages rolling off as the big sort of factor. And I guess you're saying that that's important, but it's actually the aggregate mortgage rate you have to look at.
No, I was saying that I'm not looking at the advertised 2-year, 3-year, 5-year mortgage rates, which are for new mortgage deals.
Okay,
which is to some extent is probably the ones that apply for the rolling mortgages.
Yeah,
but the issue is that you still have a lot of people that are tied into 0 to 1.5% mortgage rates.
Yeah,
and these are going to reset. And as these reset, that effective mortgage rate keeps on increasing. I mean,
so even if the Bank of England cuts rates, it doesn't necessarily mean everybody will face lower interest rates.
That is precisely the point.
Yeah.
I mean, the BOV rate is 5.25, and the effective mortgage rate right now is 3.57 on the outstanding stock of mortgages. In the Eurozone, it peaked at 4, exactly the same as the ECB depot rate. So my fear is that this thing will keep on creeping higher as we're getting more resetting, and people reset at these advertised rolling mortgage rates, and it will keep on creeping higher. And it will come at a time where the unemployment rate is rising. Yes, wage growth increases will cushion part of that, but still, we're talking about the past 3 years or so where household consumption, real household consumption has been flat. So that's my main concern in the UK, and that's the main driving force, believing that inflation cannot be sustained and that the BOV will cut by more than the market prices.
Okay, yeah.
Not this year, but the next as well.
Yeah, that makes sense. And then from a market perspective, then presumably this means that FX sounds like you're bearish on the currency, I guess. I mean, I guess it depends who you're crossing it against.
Exactly. I think, look, if you're talking about cable, I think this is pretty much a dollar story for me. And then it becomes an issue of out or underperformance relative to peers. Fundamentally, I believe that euro sterling should be higher. Of course, I understand now that we have entered a period where we're getting some repricing with European risk premia, which will make it a bit difficult in the short term. But I think that given what was initially priced, and that's the pricing evolves where we're taking out some of the ECB rate cuts and potentially going to start pricing in some of BOV rate cuts, I think that the balance of risk, but over a medium term, and it will require a pretty strong stomach to cushion potential loans along the way, I think euro sterling should be higher. I think sterling could be lower against the Aussie, for example. I mean, I know there's nothing really priced for the RBA, but equally, I think the BOV is underpriced in terms of its cuts. So that could be another interesting play, I think.
Okay, great. Now let's move on to the other election, which was more of a surprise, at least to me, the French elections.
Yes.
I was in New York last week, and then suddenly the election was all that clients wanted to talk about. So, I mean, how are you thinking about these elections? I mean, people are talking about euro breakup, redenomination risk, kind of the playbook that we had during the sovereign crisis, which you talked about earlier.
So first, let me talk about the European elections themselves, because there have been a lot of headlines. And I mean, obviously, it really depends what classifies as far right, because different parties have quite different political scopes and objectives. But let's say that we agree broadly on what constitutes some sort of far-right parties. I think if you actually look at the numbers at the main parties that fall within that umbrella, they've actually increased their seats by approximately 1.5%. So, and as a matter of fact, it was actually lower than people expected. And I have to say that this came on the back of a period where we saw even double-digit inflation in the Eurozone. So we went through an inflation crisis. It's not surprised that you get some extreme on the political spectrum flaring up. But again, I don't consider it to be that much of an impressive result for the far right, basically. Now, when it comes to particular countries, Germany and France, because this is where the problems are. I guess Germany, we can push it a bit further out, although we still have the issues of lack of some sort of agreement in the current coalition, where Germany to agree the budget by the beginning of July. So I don't think it's redenomination risk as far as French elections are concerned. I think it's mostly, I would call it political paralysis risk. And I think the main risk in all that is that we end up in a very unfortunate situation where Europe lacks a coherent and united Franco-German front to push a political agenda, especially in what seems to be emerging recently in the European circles about potential reduction in regulation in order to increase competitiveness. But also you have the Green Deals, you have budgets more broadly, you have military defense, you have aspects that concern productivity growth, and so on and so forth. You have energy. But if, history teaches us that basically Europe needs united leaders. And the leaders currently are Germany and France, and we need them to have both a coherent and a united front. So to the extent that this gets disrupted, I think we may find ourselves in a bottleneck, in a situation where we don't get political decisions. At least the process slows quite significantly. We reach a stalemate and we reach a paralysis. And this is really unfortunate timing-wise, both because we broke the taboo of common debt issuance a few years ago, and right now the Eurozone is recovering nicely. Virtually, I would say 90% of the indicators, of the high-frequency indicators that we follow, they're rebounded quite nicely, suggesting that there is a clear bottoming out and potentially a mini-boom fueled by increase in real incomes in the Eurozone. If things flare up, however, which is a risk, well, then sentiment is going to decline. The perception is going to be the Europeans again managed to reverse whatever good was happening. Portfolio flows are going to slow down or halt. So obviously, there are risks to growth, there are risks to the euro, there are risks to asset prices in Europe.
And, we've seen recently that French spreads versus bonds have really widened out significantly. And so there's a sort of debate whether that has further to run. I mean, it's already very wide from a historic basis, or is this a fade or not? Or, how do you navigate something like this? Because
look, I think
headline driven as well.
I think everybody trades based on the framework that they have and the conviction that they have in their view. So the framework that I can give you right now, I think at 81 basis points OATs versus bonds, we are actually wider than we were in the run-up to the 2017 presidential election. So it is considerable. It is a big widening. If you think that this is going to end up in a similar status quo, where you have some slowing of decision-making, but in a sense, we're kicking the can down the road a bit, or if you think that there is a clear possibility that Le Pen will take pages out of the Meloni book, i.e. soften her stance, avoid a full confrontation with the EU, because let's not forget, there is a prior. There is a prior in which extreme parties, whether to the left or to the right, have tried to confront and failed, and those that soften their stance and manage to stay in power. So there is a playbook to take for Le Pen. And of course, her chances for the 2027 presidential election. So there's a clear incentive for her to do that. If you belong into that, I think the range between 80 to 90 basis points potentially seems quite attractive, as you say, to start considering fading it. But if you believe this is potentially a make or break or a break not for the European Union, but it's a break for the decisiveness of political policy progressions and implementation, well, then potentially we can go higher than that, wider than that. I think it really depends on your base case.
And on the Meloni instance, I mean, she did, of course, as you mentioned, move more to the center when she got into power. But do you think there's a risk that if France has the RN in power at some level, that she'll have this kind of far right ally, and then she could then Meloni will move to the right, saying, I've got this French ally now. Now I can show, more of my agenda. So there'll be this like Franco-Italian far right alliance.
Again, I think there's definitely an issue here that is being created, but we have to remember these parties that we refer to differ on a vast array of policies. And this is the main thing. If we were talking about 4 or 5 main parties that were considering pulling together their forces, joining forces with a grand coalition to promote extreme ideas, it would have been different. But I find it really difficult to see how all these different parties can actually coincide together within exactly the same political platform. Even that, we have to take into account that it's not just confrontation with the EU, but it's also confrontation when you implement extreme policies with your own people. And basically, we still have examples of what happened with Syriza in Greece. Not the far right, it was to the far left, but nonetheless, we had plenty of things that went wrong. That basically, and Syriza's collapse came from within. It didn't come from the European Union. So I accept this as a risk. And I would have expected it would be a bigger risk if there was more cohesion and more uniformity across these extreme parties, but there isn't. So to me, it remains a risk, but it's not a really big risk.
And then in terms of regional nomination risk, one commonality, I suppose, between the far right parties is that they want to reduce immigration, of course. But does that also mean they'd want to try to restrict the free movement of labor across Europe? I mean, wouldn't that then lead to a kind of one of the tenets of the EU breaking down?
Well, I assume yes. But when you water down your stance into the main sticking points with the EU. And the main sticking points with the EU are, of course, the free movement of goods, services, and people alongside compliance with the fiscal rules. So, I mean, we have Le Pen saying that basically we will consider things along the lines of the fiscal rules imposed by the European Union. We've heard them say that they're only backpedaling on repealing the pension reform that was introduced by Macron. That automatically shaves off about a quarter of the planned increase in the budget deficit. And that's, as a start, and I suspect we're going to have more going forward. So I cannot speak for their core values. It could be not. I think ultimately what matters is what is being proposed to be implemented. And I suspect that this is not part of what they envisage, largely because it's going to break them into full collision with the European Union, of course.
And just another question on the French election. I mean, why did Macron call an election, do you think? I mean, there's all sorts of theories around this all.
I've had so many theories. I think that he thought there might be similarities with Spain. in the sense that basically, all right, fine, let's go ahead with potential cohabitation or a relative majority in the National Assembly with Le Pen. He potentially thought that she will fail in doing that, and therefore he's going to strengthen his odds and chances for the more important presidential elections in 2027. So far, it seems to be backfiring, but then again, between now and the presidential election, we still have a good 3 years to go, right?
Yeah. And you mentioned earlier that Europe's going through a mini boom right now. At least the high frequency data seems to suggest that. I mean, what's why is this mini boom happening? How strong, how robust is this? How long could it last? And what does that mean for the ECB?
So I think a large part of it, which was, I think it did not become prominent in a lot of analysts' discussions. It has been the disbursement of MGU loans and importantly grants, because the grants support growth, but they don't go into the budget, into the country budgets, right? So that's really important. That cushioned the European consumer. I think at the same time, we have been seeing a very modest recovery in China, which is adding, again, at the margin, some tailwinds via the trade channel. And you can actually see the current account deficit is really, the current account surplus is really widening in the Eurozone. And now we have the ECB that is cutting rates and inflation is falling. So real incomes have been pushing quite considerably. The other thing we have to bear in mind is the savings rate is quite high in the Eurozone still, which means that consumers are consuming, but they're also saving. So they're also building a cushion and not at the big expense, at least, of current consumption. So that's why I'm saying it's really unfortunate the time of the political developments, because the recovery so far has been going quite well. And importantly, the recovery has been led by the South European countries. Spain is going through a fantastic period. Italian growth has been high. Greece is flourishing right now. Portugal is doing quite well. And all this absent German growth, which is important, because we have had a recovery in the Eurozone without Germany contributing to it. And Germany has been bottoming out over the past couple of months, which means that in principle, it should add to the tailwinds of Eurozone growth. So that's why I was becoming more optimistic about the Eurozone growth outlook, about the Euro, also about bond yields moving a bit higher, because I also thought that wage growth is still in the pipeline, and potentially it's not going to allow the ECB to cut as much as the market expects. But right now, of course, we have political risk getting priced in. So, and if sentiment gets affected, we know the story. We've seen it before. I'm not suggesting it's going to be anywhere near the initial magnitude, but it's going to be a headwind, and it could end up being a major disruption to the Eurozone recovery.
Okay. You mentioned Greece there. Just out of interest, I mean, how's Greece fared over the last...
I'm not very close to Greece, I have to say. I mean, I would go there about once a year.
But I mean, just economically, I mean, obviously they had the Greek crisis, and then, went through effectively a depression. If you look at the data, I mean...
it was really bad.
Yeah.
It was really bad. Look, I think so far, although in general terms, disbursement of NGU funds has been slightly disappointing, meaning that it has been lagging for the majority of European countries. Absorption and implementation in Greece has been quite satisfactory. Greece, after all, is enjoying stability, having the same government with the recent elections that we had, basically giving them a second term. And that, I think, has instilled something that it was missing quite a lot from the Greek economy in the past, which is continuity. So continuity, European support, the approach of the government, which has been a bit more technocratic, a bit more pragmatic, a bit more realistic, I think it has helped. And as soon as you put one and one together, it doesn't take too much to fuel growth, especially when you're coming at from such low levels that Greece was coming.
Okay, no, that's good to hear. Now, if we go over the Atlantic to the US, the general story in the US, I suppose, there's been a bit of a soft patch in the growth data. Maybe payrolls may sort of signify a turn. Inflation generally was very high over Q1. The recent inflation data was on the low side. So it's a kind of mixed data. I mean, how are you interpreting the macro cycle then? And also what does that then mean for the Fed?
So I think, after all, the last mile is proving to be the most difficult. I see two things happening in the US right now. I see a slightly sticky inflation towards its last step towards a target, which is definitely making the Fed cautious. But equally, at the same time, I see US data slowly. If you look, for example, at the city, not economic surprises, but the city data changes, we're now having the longest streak of time since I think it was over the past 2-3 months that it has been slowing. Let me be clear, on an absolute level, we're still at okay levels, and the US economy is still growing, but nonetheless, it is slower. So it's basically a difficult mix because you don't know which one is going to crack the first. This is going to be the economy, and then it's going to drive inflation, or is inflation that is going to potentially accelerate, and then let's see what happens. Reality is the matter is that headline year over year CPI is pretty much flatlined around 3%, which is not great news for the Fed. I think if I take the balance of the mixed data, as you said, I think one cut for this year seems reasonable, potentially some probability for the market to price a bit more. As we stand right now, I think the market is pricing between 150 and 175 basis points until the end of 25. Given how things are right now, so absent any recession and what have you, it may be a challenge for the Fed, I think, to deliver that amount of cuts, unless something breaks in the labor market, because let's remember that the Fed has a dual mandate. And what is interesting in the latest projections, I thought, was that although the inflation numbers were revised higher, unemployment and growth projections were kept the same for 2024. So I'm just wondering whether this allows them more leeway to do a bit more in case we see further increases in the unemployment rate. Because remember, the forecast for the end of the year for the unemployment rate is 4%, and we're already at 4%. So what happens if inflation remains somewhat sticky with some downside trend, but we're at 4.2% unemployment by September? I don't know, but it's a challenging situation for the Fed. I think the direction that we're going to is quite clear, that interest rates are going to be reduced. The timing of when that and the magnitude, I think they're still a bit unclear. But currently, I find it challenging for the Fed. I think the Fed will find it challenging to deliver 150 or 170 basis points of easing between now over the next 18 months.
Okay, yeah, understood. Now, more generally, I mean, there's been this theme since COVID about fiscal policy becoming very active. After the global financial crisis, there's no fiscal, and it was monetary stimulus that was trying to revive the economies. This time, we've had this massive fiscal story, and so to some extent, it's really been a story of fiscal policy since then. And you mentioned with Europe, the disbursement of grants has helped cushion the slowdowns within Europe, and is perhaps helping the recovery now. US has been helped a lot by fiscal. But there's, a lot of these numbers are going to start to roll over in terms of fiscal stimulus, at least when you look at fiscal impulses. So what's your take on where we're going on the fiscal side?
So I think the two aspects in it. One has to do with the pragmatic approach that we've increased deficit, that deficits increased pretty much broadly and quite significantly, which means that we should be positioned and await a wall of issuance over the next few years. So that's really important. And the second one, I think it has to do with the element of perception. As you correctly pointed out, the pandemic has set a priority in which there is a public demand for fiscal policy to be a bit more active now in order to cushion various blows. I think the US does have an issue with the fiscal policy that it currently pursues, and who knows what the fiscal policy is going to be post the November elections. The initial consolidation we were expecting in the Eurozone will turn out to be a bit smaller. The UK is on course for some consolidation, but again, this can be subject to change. My general sense is that over the next few years, we're going to be confronted with slightly higher deficits than we currently expect and significant amount of issuance. And I think this has been caused by the fact that governments may be realizing that it becomes some sort of a public demand because it effectively cushioned what it was a big and exceptionally big cyclical hit, which means it doesn't have to be there when you're in a recovery. But then again, political parties may actually think differently when they feel there is a public demand for it. So I'm worried that we may see more deficits than we currently expect.
And so from a central banking perspective, what does it mean for them when they're confronted with these high level of deficits?
So on the surface, it would mean it makes their life more difficult because you would expect that looser fiscal policy is going to imply potentially some bigger inflationary pressures. Now, if there is some differentiation across countries in where fiscal increases, fiscal stimulus, or smaller reductions in deficits are being used in channels where they can, at least at the margin, set the stage for some marginal productivity improvements, then further down the line, that could be slightly beneficial. I am somewhat reluctant to accept that governments can really affect the trajectory of productivity growth, to be honest. And I don't think there is a lot of empirical evidence to substantiate that. But I'm open to debates and arguments in favor of this. But I think on the surface, it could make things more difficult, more challenging for central banks.
Okay, great. Well, we've covered a lot of ground, so I just wanted to round off with a few personal questions. One I like to ask all my guests is, we do have some youngsters listening to the podcast as well. Many of them are, finishing up their university degrees. It's summer coming, and then they'll be applying for jobs in the real world. What advice would you give to people as they're young, people as they enter the world that we have right now?
Well, in the job search, what I would say is don't simply rely on algorithms, because right now there is a lot of algorithmic selection of CVs going on. Make sure you approach the right people, and there are channels that you can do it. Just make sure you do that and establish a relationship, because you are actually showing that you care and that you're very much interested. On the job, look, I mean, I don't like to sound like I'm having some magic recipe or wisdom or whatever, because the reality is I don't. I think, keep your head down. Don't take things personally. It's a difficult environment. It is a very tight labor market. I think you just find your niche and you just work on it as much as possible.
Yeah, that makes sense. Absolutely. And then finally on books, I'm always on the lookout for good books. I mean, what are some of the books that influenced you during your career, or maybe books you've read recently that you've really enjoyed?
So some of the books that I read recently, and I found them quite fascinating. Well, this one in particular, I think it's impossible to prove, but then again, it has to do with biocentrism, that was the first book. The second one was Beyond Biocentrism by Robert Lanza and by an astronomer, Bob Berman, I think. And it is really about a lot of the failures of the modern theories to explain the world around us. And I think the bottom line out of this is that It may sound a bit strange, but the world doesn't really exist unless we exist and we interpret it. And our interpretation is really an important element into even other people's interpretation. Another book which I thought was fascinating was, I think it's a recent book. It's called Noise. I don't know if you've read it. It's by Daniel Kahneman, I think, and Cass, what's his name? Cass Sunstein. And it talks about the concept of noise, the concept of randomness. I'll just give you an example right now. On Mondays, judges in the US, on following weekends where the favorite team lost, they're far more likely to impose harsher sentences. And it's unbelievable, but, it is what it is, right? So they propose a number of remedies for this, but I think beyond the remedies, I think it is quite astonishing how many things they report there and how much our life is really affected by randomness and by noise.
Yeah, that's great. And then what's the best way for people to follow you? If
I think on LinkedIn,
Okay.
it's fine. I mean, I used to be a bit more active on LinkedIn. Right now, with a new job, I'm obviously quite engaged and quite busy there, but I try to put stuff there as much as I can do. But it's the best channel, I think.
I'll include that on the show notes. So with that, I mean, thanks a lot. A
Thank
great
you very much.
run around the world and on all the relevant issues. And good luck, at Aviva.
Thank you.
And I'm sure you do super well there. And look forward to staying in touch.
Thank you very much indeed. And thank you for having me. All the best.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.